Hello and welcome. You're watching All About Your Company, and today we're going to be talking about a company with a nearly 15% market share in the India tyre market. It's CEAT that we're going to talk about. It's been a very solid compounder over the last 3 years since the cycle has turned, especially with regard to raw material prices, and it has seen plenty of tailwind. What next for it? A Camso acquisition, of course. How is that playing out? That's one of the pieces that I want to know. The other piece is also they are expanding presence into UK and Germany with subsidiaries there. What does that mean going forward? But the first piece, will top line grow at double digits? That's the growth guidance. For how long are we going to continue to see that kind of growth is the first thing I'd want to know. Second, volume. They've suggested volume will also grow at double digit. But here's the kicker. They've guided CV volumes to be at low single digit. They've guided PV volumes to be at mid to high single digit. Now, where is this double-digit volume going to come from? Is it going to be exports? Is it going to be three-wheelers and two-wheelers? Is that where all the growth is going to come from? I'm going to try to break that down as well. The third piece, subsidiaries. UK, Germany is what they have incorporated. What therefore is next with regard to UK and Germany in terms of the market? Can CV demand surprise on the upside? Because that low single-digit volume number not really convincing me fully. Given the fact that we have seen GST rate cuts, could that change materially going forward? And whether they're seeing underlying demand pickup in this space. We spoke to Chola Finance earlier today, and they suggested that disbursements have been extremely strong. In fact, surprised on the upside. So maybe that correlationship here as well. Let's talk about GST. But beyond GST, there's capacity utilization plans, especially post the Camso acquisition. For Camso in particular, capacity utilization is at 50%. Can that see a significant uptick? What gives them confidence that 13 to 14% margins will remain as is, despite the possibility of upward pressure from rubber prices if that were to come through? They've guided for a stable 13 to 14%. We'll try and understand how they are hedging it. Last off, if there is a US tariff resolution, can there be a material upside that we can see in terms of demand from the US? So let's try and get all of that together, and let's first try and understand what CEAT is all about. It's no, it's not a story that really needs explaining. It's an RPG group. It's a leading Indian tyre manufacturer. It was founded in 1958, part of the Tata stable, thereafter taken over fully by RPG in 1981. It manufactures around 5 crore plus tyres every year. At least that's the kind of capacity it has, and it exports to over 100 countries. Let's talk about the product and the mix, and here's where it starts getting interesting. The truck bus segment is approximately 30%, which is heavy duty radials. They also do passenger and utility vehicle radials, which is roughly 27% of the mix. 2 to 3 wheelers contributes around 21%. Off highway, agri and mining, including Camso, is approximately 15% of the revenue mix, and light commercial vehicles is around 7%. So it's got a very healthy mix. CV versus PV, if I club agri into CV, it's around 52% within the CV space, 48% within PV. So they've got a good mix there. Look at the manufacturing facilities, India and Sri Lanka. Sri Lanka is largely Camso, and therefore that's the recently acquired setup that they have. Now let's talk about the geography. Domestic, around 81% is what goes to the domestic market, 19% goes to the export market. Let's talk about where within export: US, Europe, Africa and Latin America. That's the broad range, broad basket where it goes. And in terms of domestic, it has 38 regional offices, 61,000 touch points through which they distribute, and that will reflect on the product mix. 53% of the product mix is replacement, 28% is to OEMs, which is to car manufacturers, and the balance 19% is to exports. That's the broad mix. Mind you, one thing to note, replacement always has better margins than to OEMs, because OEMs is B2B, replacement is B2C, and therefore they enjoy better margins there, and they have a significantly better share there than on the OEM front. Let's talk about the metrics now. That's the top line growth. The top line growth is around 12% CAGR over the last 3 years. And when you're looking at the H1 growth in terms of the top line as well, it's done 12% in H1. EBITDA though has grown much faster because FY 23-24 and the base year saw a lot of volatility with regard to raw material prices, whether it's crude, whether it's rubber. All of that has stacked up and added to a very low margin, which it was making in those years. Thereafter, we've seen a margin pickup, and therefore, that's what you can see on the EBITDA metrics. It's gone up sharply, and profitability is exactly what you are seeing as a result of that EBITDA uptick. We've seen very, very strong surge with regard to profitability. Now, let's talk about H1 FY26. We've seen 12% revenue growth, 20% EBITDA growth, and a net profit growth of around 23%. So it's been a good set with regard to H1, even versus what they've guided for. They're largely in line with their guidance. Look at the margin trajectory now. That's the second metric. But what you're seeing here is volatility. And that is not something that an investor likes. That's why we've given this a neutral. The amount of volatility or the quantum of volatility is fairly large. And therefore, at the end of Q2 FY26, the margins sat at 13.3%. And at Q1 FY26, the margins were at roughly 11%. So you're seeing choppiness with regard to margins. In fact, FY23 was 7 to 8% margin. FY23 was 8 to 9% margin. FY24 was around 13%. So there's been this choppiness with regard to where margins is concerned. Let's look at the balance sheet now. And within that balance sheet, you're seeing a decent amount accrued to book. But the borrowing number also looks large. So that 1900 crore in terms of borrowing stacks up the debt to equity at roughly 0.64 times odd. And therefore, what you're seeing is that, but if you look at the cash on the balance sheet, there's a decent amount of cash sitting in the balance sheet. There's around 460 crore of cash which is sitting in the balance sheet. That's the other piece you want to kind of know. That despite the debt, there's also a decent amount of cash sitting. But there are commitments, right? They've made a commitment to Camso. $225 million is what they're going to acquire Camso for, out of which $138 million has been paid, which is why you're seeing a bit of a spike on debt. Out of that, 88 still pending, 43 and $44 million. 43 in the next year and 44 3 years from now is what they have to still disburse. Let's talk about the return ratios. Along with the margins, these also have been choppy, as you can see, and therefore you're not exactly the best placed in terms of predicting the return ratios. It's been quite choppy in that sense. Let's look at the shareholding. 47% held by promoters. Now, this is not 50% plus, so technically we shouldn't be giving this a thumbs up, but because the promoter comes from a large group, a large conglomerate in India, and the 47% has been extremely stable, we've given this a thumbs up as well. There is decent FI participation, but it's come off from the highs of FY24. DIs have inched up in terms of their participation, and the public has been with the residue. Let's look at the number of shareholders as well. It's come off versus FY25. So we've seen a bit of a change with regard to the number of shareholders that's there here. Let's talk about valuations. It currently trades at around 18.5 times 1 year forward. The 5-year average has been between 11 times and 22 times. This is a price to earnings multiple. The other way to value this is, of course, EV to EBITDA as well, but largely a similar trend even where EV to EBITDA is concerned. So when you're looking at the ranges, it's trading at a slightly elevated range versus its 5-year range, and versus the 5-year average, which is around 16 times, it's trading at a premium. Very similar when you're looking at EV to EBITDA as well. So therefore, we're not covering it and making it unnecessarily more complicated. The price to earnings ratio, that's how we've looked at it. Now let's look at analyst recommendations. 15 buy calls, 2 holds, 4 sells, 7% upside is what analysts are seeing on this one. Again, cautious both on valuations as well as on analyst take, because while analysts do have coverage, but just a 7% upside, they're not seeing enough juice left in this one. So broadly, let's stack up all of the metrics and let's try and get your perspective. Oh, okay. There's growth guidance, of course. Top line volumes, we've spoken about this, double-digit growth guidance. CV is low single-digit is what has been guided for. When you're looking at margins, expected to be stable between 13 to 14%, 1,000 crore of capex in the pipeline. Camso capacity utilization currently at 50%, $87 million paid to Camso for the acquisition. Sorry, yet to be paid to Camso for the acquisition. 1 year from now, they'll pay around 43 million, which is next year, and thereafter they'll pay $44 million, which is due 3 years from now. So, and that's the broad snapshot of how the performance metrics have stacked up. Certain things you, of course, need to be mindful and cautious about, but outside of that, it's a decent overall set. Let's go across, speak to Arnab Banerjee, MD and CEO of CEAT Limited, to talk to us about what to expect going forward. Mr. Banerjee, great having you. First off, let me start off. Good afternoon. Is there an upside possibility to your CV guidance? Because the GST rate cuts that have come through, are you seeing better traction on the CV business, which should likely provide a little bit of higher edge even on your overall FY26 numbers? Give us an indication of that first.
Yeah, so in the month of September, there was a downstocking in aftermarket trade overall for all category of tires. And we, in fact, had a degrowth in aftermarket in the month of September, which is part of Q2. And so that downstocking, we'll have to wait and see over 3 months, but that downstocking should come good or reverse in Q3 in aftermarket. We are already seeing some good traction in terms of vehicle sales from OEMs in CV, because that's what you alluded to. And in aftermarket, the demand has come back strongly in two-wheeler and farm, particularly in smaller towns, post the GST reduction. So we are seeing overall neutral to good traction in terms of demand in Q3 in aftermarket. And in OEM also, the CV part has come back definitely.
There is an upside surprise to that very low single-digit kind of growth guidance that you've given for CV?
Well, that guidance was primarily for aftermarket. So in aftermarket, I will stick by the same kind of level, because in such a short span of time, the aftermarket doesn't change for CVs. But the OEM volumes are looking up. So over a period of time, there could be a positive impact on the aftermarket volumes also.
Okay. And would you say that will take 3 to 4 months to translate by over a period of time? How would you quantify that?
Well, we enter a positive season in terms of annual seasonality from March to June. The summer months are usually good for commercial tires. So in that period, we can have an acceleration growth in the aftermarket for commercial vehicle tires also.
Okay. All right. Talk to us about volumes overall. You've guided for a double-digit aspiration in terms of volume growth as well as top-line growth. I'll cover both of those. So talk to us where that will come from very likely. Is it going to be two-wheelers, therefore, because that's where you're seeing traction? Is it going to be rural and agri especially, because that's where you're seeing traction? Where should one see that double-digit growth come from?
Well, first of all, I think the international business is looking up, which is the sales that we do outside India. And though the tariff situation is still unclear, we are seeing good buoyancy in volumes in Europe, in Middle East, as well as in Southeast Asia. US also is steady, but our stakes in US are still very low, less than 3% of our total turnover. So that's one area of growth in the second half of the year going forward. Within the country, two-wheeler, yes, as you mentioned, two-wheeler in tier 2, tier 3 towns and rural markets is looking strong. Two-wheeler tires, both scooter and motorcycle tires. Farm tires have been doing well, but farm enters a lean season now and will pick up again from the month of March. So farm and two-wheelers are the brightest spot. We expect, as I mentioned earlier, that commercial vehicle sales will pick up March onwards, commercial vehicle tire sales. And passenger car tires, passenger tire sales are a little bit muted, but should look up again from March.
And sustenance of this demand? For example, we had a leading two-wheeler manufacturer who came out and guided that the next 2 years, typically, they would likely see a double-digit growth, especially the industry. The industry will likely see a double-digit growth. Your sense with regard to sustainability of the double-digit growth guidance that you are giving, do you believe that it can sustain maybe 2, 3, 4 years?
The vehicle penetration is still very low in India. So there is definitely headroom for growth. The GST reduction, the income tax changes have put more money at the disposal of the customer. So we definitely see all these developments as a positive for sustained growth, not only in two-wheeler and agri, but also in four-wheelers over a period of time, because the penetrations there are also pretty low. So we are quite bullish on the demand scenario in domestic market for in the medium term of, let's say, a couple of years.
Okay, and the export market, which is where you've got your or acquired your growth from, what's the sense there with regard to how is growth holding up over there, and how are tariffs and other factors influencing the kind of growth that you're clocking?
So export has been a good bright spot for us over the year, particularly going forward. And with the acquisition of Camso, there'll be a lot of synergies kicking in the channel in US and the European market. There are common distributors, and there are OEM customers who also who take both construction tires and agri tires. So we are yet to reap the synergies, which will start doing with effect from FY27 gradually. Right now, we are in a transition phase with Camso. We are also investing a lot in building the brand in key markets, launching new product ranges in key markets of Europe, US, also Latin America, and Southeast Asia. So there's lots happening there in terms of our own initiatives, which is completely incremental to the growth story that we have had so far.
And the rationale for incorporating subsidiaries in Germany and UK, what's the thought process there?
Well, the thought process there is that we would like to go closer to the customer. The OEM customers would definitely demand just-in-time kind of service. And even the replacement customers, especially the channel partners, we will have access to many more channel partners of different kind of sizes if we have local warehousing. So that's the direction that we are gradually going to take. So the incorporation of these companies are going to help us do that.
And say the US tariffs get resolved tomorrow, would you therefore see significant upside in case of a resolution in terms of demand?
Well, US is a very big market, and our stakes are very low. We've just started our game in US, first in the off-highway tire, and now following up with truck, bus, radial, and four-wheeler. So in any case, the upside is huge for us in US, whether there's tariff or not. But yes, the tariff situation, when it gets resolved, then it will be a much smoother process of accessing channel and doubling up on the product range as well as on the marketing programs. We have not, reduced our spending or reduced our initiative because of the tariff, but it's going to pay up handsomely once the tariff situation gets resolved.
Perfect. So yeah, that makes more sense. There's significant upside sitting there. With regard to Camso in particular, you're currently at around 50% utilization, if I understand right.
Yes.
How's the ramp up playing out? Give us a pulse of how quickly can it play out, and what's the future in terms of the way forward where the Camso brand is concerned. Are you diversifying outside of Canada in a significant fashion? Are you seeing probably some of those synergies play out, and how quickly?
Yes, so right now we are in a transition phase where we are starting to handle the customers directly. In the transition phase, Michelin continues to handle the customer. We are actually selling to Michelin, who is selling to the customers, right? So as and when we keep taking over the customers and start handling them directly, we will be able to do adequate changes in the marketing mix, and that is when the ramp up will start. As far as the ramp up is concerned, we will be steady till about March, definitely. Post-March, the ramp up will gather acceleration when we have a handle on most of our customers directly. So that's the plan. So far, the operations in terms of supply chain and factories are running absolutely smoothly. There is practically no deviation from the due diligence that we did. So we are very happy about that. But the customer acquisition and the ramp up will have to wait for another maybe 3 odd months.
just circumventing the US tariff to a certain extent by sending goods through Sri Lanka due to the Camso acquisition. You are able to leverage on that. Give us a sense on how is this placing you versus competition in terms of pricing and in terms of brand penetration at this point?
See, Sri Lanka has a duty of around 20% for US, and India for off-highway has 50%, and for on-road tires has 25%. So Sri Lanka has a temporary advantage, I think. Once the dust settles, it will be more or less close to equal, if not equal. And hence that country advantage will not be there. So it's just a temporary opportunistic thing. So we don't bank upon doing that for a longer period of time.
Okay. And in terms of US penetrating the market, how hard is it? How are you placed in terms of pricing and in terms of brand?
Well, no market is easy. Even India market is very tough. US is very tough. But the good thing is that the volumes are massive and the market is doing well. So in terms of pricing, we have always adopted a value-based pricing approach, which means I give you absolutely top-rung quality at a value pricing. So the quality benchmarks are very, very high. We benchmark with the leaders in various segments in the US and also in Europe, which are different kind of benchmarks. The product ranges are therefore different. The quality parameters are different. The regulatory framework is different. So we play absolutely local. We have local teams there. Local warehousing is now, as I mentioned, is going to be the next set of initiatives. So we are quite bullish in terms of a reasonable market share in these categories, which I mentioned in the US market coming up.
So in the past, you faced raw material price fluctuations, and that's impacted some of your numbers. Now what you're saying is you're more confident of a 13 to 14% margin and stability there. What gives you that confidence? What's changed?
So first, apart from raw material, the mix that we are pursuing is a focus on international business. International business is margin accretive. It is at an operating margin level more profitable than replacement market in India. So our push for international business at value pricing.
Guys, ये BP capital में होना चाहिए.
Yeah. Therefore, that is going to play out the mix. Then within the domestic market, focus on premium SKUs in the passenger segments of two-wheeler and four-wheeler. Also, premium SKUs in truck bus radial, that's going to play its part. Apart from the secular trend of raw material, which is going to impact all players almost equally. So we have nothing unique there apart from our focus on cost control, which you will see is tapering off over the last 7-8 quarters, and we'll continue to focus on that. But raw material prices will be benign, flattish to minor, maybe drop, maybe more or less flattish in the second half vis-a-vis quarter 2. So that gives us an opportunity to stabilize margin and have a lesser variation on the margin front going forward.
So how much better are margins in export versus domestic? And apologies for that interjection. But how much better are they?
It varies from quarter to quarter depending on the exchange rate, the mix, and the country that we are selling to. But it could be anywhere between 3 to 5% better.
Okay. And last piece with regard to return ratios, therefore, how confident, how comfortable are you with maintaining this 15 to 20% kind of ROC? Is it something that you aspire for or you're comfortable guiding for?
No, we aspire for mid double-digit post-tax ROC. So we have not been able to deliver that consistently in the past. So the key thing in our thinking is consistency, stability, both at the operating margin level as well as the ROC level. Fluctuations because of raw material fluctuation is something which we are keen on smothering by investing in the brand, by investing in R&D, and by investing more in margin accretive business.
Okay, Mr. Banerjee, it's been a pleasure speaking. Thank you so much for coming in and speaking with us. Great perspective,
Thank you very much.
viewers all across. When you're talking about demand, when you're talking about how the business functions, what the levers are in terms of export demand versus domestic, and in terms of what is better in terms of business for CEAT. Across the board, it's been a great conversation. Viewers, hope you found this productive. All the time we have on the show for today. From me and everyone who puts this show together, thanks so much for watching.